guys, I'm Annie from FX Scouts. So in this video, I want to go over a technical indicator called the average true range, and I want to show you how you can effectively use it to set your take profits and stop loss levels, but also how you can use it as part of a trading strategy. So let's start with the basics. The ATR is basically an indicator that helps to measure market volatility. In other words, it measures how much a currency pair moves over a certain period of time. It's very important to note that although it shows you the volatility of an asset, it does not give you the direction of the trend. So to calculate the ATR, you need to understand what true range is. And true range takes into consideration the current high minus the current low, the absolute value of the current high minus the previous close, then the absolute value of the current low minus the previous close. The highest of these three values is taken as the true range. The average true range is then the moving average of the true range over a specific period, which is typically 14 days, depending on your settings. So generally, you don't have to calculate this. Your trading platform will do the calculation for you, and it will generally appear as a line at the bottom of your chart. So what you'll see is the range of values on the right-hand side. If you move your cursor to any point on the line, it should show you the average true range value for that point in time. And you can basically guesstimate the ATR just with a quick glance at it. Now that we know what the ATR is, let's discuss how you can use it as part of a trading strategy. So the ATR helps you understand market volatility, as we mentioned before. A high value ATR indicates high volatility, meaning price movements are larger. Conversely, a low ATR suggests low volatility and smaller price movements. This information is crucial when setting your stop loss and take profit levels. So understanding what the ATR value is telling you will help you to set your stop loss so that you don't prematurely get taken out of a trade. For instance, if you're in a swing trade and you know that Euro USD has moved around 100 pips a day over the last month, then setting your stop at 20 pips will probably get you stopped out too early. A common approach is to set your stop loss at a multiplier of the ATR away from your entry point. So for example, if you're entering a long position, you might set your stop loss 1.5 times the ATR below your entry price. As you can see on the USD ZAR chart, the price is 18.68 Rand to the dollar with an average true range of around 23 cents or 0.23. This means that the average true range over the last 10 days is around 23 cents. So to set my stop loss, I would place it at 0.34 or 34 cents below the current price at 18.34. That's 1.5 ATR. The take profit can also be set as a multiple of the ATR above the entry point for long positions or below for short positions. The multiplier used can depend on the trader's risk tolerance and the asset's volatility. Next, the ATR can also help you identify breakout opportunities. So when the ATR spikes, it often signals a significant price movement, possibly indicating a breakout. You want to keep an eye on it because it might hint the start of a new trend, as you can see here, where the ATR spikes with this green candle and the trend continues up for a couple of weeks. I want to quickly dive into a demonstration of how to place your ATR on your trading platform, how to set it up, and then how you can interpret the data. So you'll open your trading platform. Here we're using TradingView. Then you'll go to the indicator section and search for average true range. You'll select that and you'll see the default setting is 14. You can change it here, and I will make it 10 because this is the period I generally use. Now that we know how to do that, I want to show you a trading strategy using the ATR, using an ATR of 10 in particular. So first you add the ATR as we just did. Next you'll overlay the 20 period EMA or exponential moving average on top of the ATR. And you can do this by clicking on the 3 dots on the ATR information bar and clicking on add indicator or strategy on the ATR. You will then add an EMA and you'll set it to 20. Next, if you look at the chart here, you will wait for the ATR to break above 20. A breakout in the ATR indicator reading above the 20 EMA is indicative of higher volatility to come. And as you can see, the ATR broke above the 20 EMA multiple times, but it didn't always end up in an uptrend. When using the strategy, you also want to look at the price action to confirm the increase in the ATR volatility. And this brings us to the next step in the ATR trading strategy. So after the ATR line broke above the 20 EMA, we want this to be followed by a break in price as well. So if we're looking to buy, we want to see a big bullish candle relative to the previous candles popping up on the chart. If the price breaks up and is accompanied by a break higher in volatility, then there is a high probability of the market moving in the same direction. Next, we want to establish how you enter the trade once you've seen both of these things occur. In other words, you've seen the ATR pass above the 20 EMA and you've seen a big bullish candle in a long position. Depending on your preferred time frame, you'll have to wait till the breakout candle has developed. Then you'll enter long once the next candle breaks above the high of the breakout candle. In this case, it would have been 1835 on the USD ZAR chart. And so I place my buy order at 1835. The ATR is also great for setting your profit targets, as we discussed earlier. So if you know how much the market is prone to move, then you can conform to this reality and have that as a target. In our case, we can see that the ATR volatility reading has a value of 0.35341 or 35 cents around about, and this means that our profit target should be calculated at 0.35 above the high of the breakout candle. The breakout candle high is at 1835, and so our profit target would be 1870. So in terms of setting your stop loss, you can obviously set the stop loss at 1.5 ATRs below the entry point, or in this case, because this is a break below the breakout candle will invalidate your trade, and this is the place we want to hide our protective stop loss. Now this example was one of a buy trade, but the same principles would apply to a sell trade. So you would also wait for the ATR to move above the 20 EMA, even though it's a downtrend, but the only difference is that you'll need a bearish breakout candle for a sell trade, and you will place your take profit below your entry price and your stop loss above your entry. Thank you so much for watching. If you have any questions about the ATR or any other Forex related questions, please don't hesitate to contact us. Our website is ethicsscouts.com. And if you found this video helpful, please don't forget to like, subscribe, and hit the bell icon for more Forex insights and trading tips.